September 15, 2008, 7:47 a.m. Lehman Brothers. Holdings files for Chapter 11, bankruptcy. $639 billion in assets, $613 billion in debt. The largest corporate bankruptcy in American history. By 9:30 a.m., when the opening bell rang on Wall Street, the Dow Jones plunged 504 points, the biggest single-day drop since September 11, 2001. By the end of the day, $10 trillion in global stock value had begun evaporating. Banks stopped lending to each other. Money market funds froze. The entire financial system seized up like an engine without oil. And the man who ran Lehman Brothers? Richard Fuld. The gorilla. He walked away with $484 million, 3 mansions, a ranch in Idaho, and 0 criminal charges. This is the story of how a 158-year-old bank destroyed the global economy. How mortgage loans to people who couldn't afford them became AAA-rated investments. And how the people who caused the crisis got rich while you lost your job, your home, and your savings. Lehman Brothers didn't start on Wall Street. It started in a general store in Montgomery, Alabama, 1844. 3 German Jewish immigrants, Henry, Emanuel, and Mayer Lehman, sold dry goods and cotton to farmers. By the 1850s, they'd pivoted to cotton trading. After the Civil War, they moved north to New York and became commodities brokers. Over the next century, Lehman Brothers evolved into one of Wall Street's elite investment banks. They underwrote bonds. They financed railroads. They survived the Great Depression. In 1994, American Express spun Lehman off in an IPO. Richard Fuld, who joined the firm in 1969, became CEO. Under his leadership, Lehman transformed. They abandoned conservative banking. They embraced risk, proprietary trading, derivatives, securitization, and after 1999, when the Glass-Steagall Act was repealed, the Depression-era law that had kept investment banking separate from commercial banking, Lehman and its competitors went wild. By 2007, Lehman Brothers was the 4th largest investment bank in America, 28,000 employees worldwide, a market value of $60 billion, record profits of $4 billion. Richard Fuld had been CEO for 13 years. He was the longest-serving CEO on Wall Street. Institutional Investor magazine named him America's top CEO. He earned $34 million in 2007 alone, nearly $500 million since 2000. He was untouchable. Until he wasn't. Here's where it starts. The housing boom of the early 2000s. Interest rates were low, credit was easy, and the American dream, home ownership, was suddenly available to everyone, even people who couldn't afford it. Mortgage lenders started handing out loans to anyone with a pulse. No income verification, no down payment, subprime mortgages. These were loans given to borrowers with terrible credit, people who would never qualify under normal circumstances. The logic was simple. Housing prices always go up. If the borrower defaults, the bank forecloses, sells the house for more, and still makes money. Foolproof. Except it wasn't. Wall Street saw an opportunity. Banks like Lehman Brothers started buying up these subprime mortgages by the thousands. They bundled them together into something called mortgage-backed securities, MBS. Then they sliced those bundles into tranches and sold them to investors as safe, high-yield bonds. Credit rating agencies, Moody's, Standard, and Poor's, gave these toxic bundles AAA ratings, the same rating as U.S. Treasury bonds, the safest investment on earth. It was all a lie. Between 2003 and 2004, Lehman Brothers acquired 5 mortgage lenders, some specialized in subprime loans. By 2006, Lehman was one of the biggest players in the mortgage-backed securities market. They weren't just packaging and selling these securities. They were keeping the worst ones for themselves. When they securitized mortgage bundles, they sold off the best loans and held on to the riskiest. It was like selling gold-plated garbage to investors while keeping radioactive waste on your own balance sheet. By the end of 2007, Lehman held $111 billion in mortgages and real estate-related securities, more than double what they held the year before. They were all in on housing, and housing was about to collapse. The first cracks appeared in 2006. Home prices stopped rising, then they started falling. Foreclosures spiked. Subprime borrowers began defaulting in waves. Suddenly, all those mortgage-backed securities weren't worth what the rating agencies said. Banks tried to sell them. Nobody wanted them. The market for these assets dried up completely. They became toxic assets, investments so risky and worthless that no one would touch them. In March 2008, Bear Stearns, Lehman's competitor and the second-largest holder of mortgage-backed securities, nearly collapsed. The Federal Reserve arranged an emergency sale to J.P. Morgan Chase for $2 a share. A company once worth $20 billion sold for $240 million. Wall Street panicked. If Bear Stearns could fall, who was next? Everyone knew the answer: Lehman Brothers. In June 2008, Lehman reported its first quarterly loss in 14 years, $2.8 billion gone. The stock plunged. Fuld fired the CFO and president. He tried to calm investors. "Our global franchise and brand have never been stronger," he said in a press release. He was lying. Internally, executives were warning him. One email from January 2008 read, "In the current environment, liquidity can disappear quite fast." Fuld ignored it. Instead, Lehman paid out nearly $5 billion in bonuses in 2007. Fuld himself got $4 million. They spent $4 billion buying back their own stock, $750 million in dividends. They were hemorrhaging capital while pretending everything was fine. By September, Lehman's stock had lost 73% of its value. Rumors swirled that they'd be the next to fall. Hedge funds pulled their money. Clients fled. Credit default swaps, bets against Lehman's survival, spiked to 1,450 basis points. The bank was dying. September 9, 2008. Lehman's stock plunges 45% in one day to $7.79. A year earlier, it was trading at $86. South Korea's development bank had been in talks to buy Lehman. The deal collapsed. Investors knew Lehman was finished. September 10th. Lehman announces another quarterly loss, $3.9 billion. They write down $5.6 billion in bad mortgage assets. Fuld tries everything. He pitches a spin-off of Lehman's commercial real estate. He begs for buyers. Bank of America considers it. Barclays of London considers it. Nobody wants the whole company. The toxic assets are too risky. September 12th, emergency weekend. Treasury Secretary Henry Paulson, formerly the CEO of Goldman Sachs, summons Wall Street CEOs to the Federal Reserve Bank of New York. The message: find a private solution. The government will not bail out Lehman. Why? 3 weeks earlier, the government had taken over Fannie Mae and Freddie Mac, the mortgage giants, at enormous cost. A week before Bear Stearns, the Fed had helped arrange the rescue. Paulson and Fed Chair Ben Bernanke drew a line. No more bailouts. Bank of America walks away. They decide to buy Merrill Lynch instead for $50 billion. Barclays wants Lehman's assets but not its liabilities. British regulators block the deal. By Sunday night, September 14th, it's over. Lehman has no buyer, no government rescue, no options. Monday, September 15th, 2008. 1:45 a.m. Lehman Brothers Holdings files for Chapter 11, bankruptcy protection. The numbers are staggering. $639 billion in assets, $613 billion in debt, over 1 million creditors, 26,000 employees worldwide, $40 billion in client assets frozen. It's the largest bankruptcy filing in U.S. history. At 9:30 a.m., the New York Stock Exchange opens. Chaos. The Dow Jones Industrial Average plunges 504 points, 4.4%, in a single day. The worst drop since 9/11. But that's just the beginning. Within hours, the contagion spreads. AIG, American International Group, the world's largest insurer, is on the verge of collapse. They'd insured billions of dollars in mortgage-backed securities. Lehman's bankruptcy triggered massive payouts AIG couldn't cover. On September 16th, the Federal Reserve bails out AIG with $85 billion, the same government that refused to save Lehman. Money market funds, supposedly the safest place to park cash, start breaking the buck. One fund, Reserve Primary, had invested in Lehman's commercial paper. When Lehman failed, the fund's value dropped below $1 per share. Investors panicked. $144 billion fled money markets in 2 days. A bank run, but for funds. The credit markets froze. Banks stopped lending to each other. Companies couldn't get loans to make payroll. The entire financial system was seizing up. By the end of September, Washington Mutual, the largest savings and loan in America, failed. The FDIC seized it. Wachovia nearly collapsed. Merrill Lynch, sold in desperation, avoided Lehman's fate by days. On October 3rd, Congress passed the Emergency Economic Stabilization Act, the $700 billion bailout known as TARP, Troubled Asset Relief Program. The government started buying toxic assets and injecting capital into banks. But the damage was done. By March 2009, the Dow Jones had fallen from 14,000 to 6,500, a 53% drop. $10 trillion in global stock value evaporated. 8.8 million Americans lost their jobs. The unemployment rate hit 10%. Home prices dropped 40%. Foreclosures skyrocketed. Entire neighborhoods were abandoned. This wasn't just a financial crisis. It was the Great Recession, the worst economic disaster since the 1930s. And it all started with Lehman Brothers' collapse on September 15, 2008. So, what happened to the people who caused this? Richard Fuld testified before Congress in October 2008. Representative Henry Waxman asked him point blank, "Is it true you took home $484 million since 2000? Fuld, visibly uncomfortable, corrected him. "It was closer to $350 million. He paused. "That's still a lot of money." Fuld was never charged with a crime. The SEC investigated. They found accounting tricks. Lehman had used something called Repo 105 to temporarily move $50 billion off their balance sheet before quarterly reports, making their finances look healthier than they were. But proving criminal intent? Too hard. Fuld walked. He transferred his 15,000-square-foot Florida mansion to his wife for $100 to shield it from lawsuits. He kept his Greenwich, Connecticut estate, his Sun Valley ranch. He joined a hedge fund in 2009. Today, Richard Fuld's net worth is estimated at $250 million. Meanwhile, the Lehman employees, 26,000 of them, lost their jobs overnight. Their pensions, tied to Lehman stock, became worthless. Millions of Americans lost their homes, their savings, their futures. The people who caused the crisis got rich. The people who suffered had no one to blame but the invisible hand of the market. Here's what Lehman Brothers taught us, and what we keep forgetting. First, when banks become too big to fail, they're also too big to exist. Lehman's bankruptcy nearly destroyed the global economy. If a single company collapsing can cause $10 trillion in losses, that company has too much power. Second, deregulation kills. The repeal of Glass-Steagall in 1999 let investment banks gamble with the economy. They took insane risks because they knew, deep down, they'd be bailed out. Lehman called that bluff, and we all paid the price. Third, rating agencies are corrupt. Moody's and Standard & Poor's gave AAA ratings to toxic mortgage securities because they were paid by the banks packaging those securities. Conflict of interest? Of course. Illegal? Apparently not. Fourth, no one goes to jail. Not Fuld, not the rating agency executives, not the mortgage lenders who handed out loans to people who couldn't pay. The only person who went to prison for the 2008 crisis was a single mid-level Credit Suisse trader. One person, for the biggest financial disaster since the Depression. And fifth, history repeats. In 1929, Black Tuesday. In 2008, Lehman Brothers. In 2023, FTX. Different names, same pattern, excessive leverage, fraudulent accounting, reckless greed, and when it all collapses, the rich walk away while everyone else suffers. September 15, 2008, wasn't just the day Lehman Brothers died. It was the day we learned that the system isn't designed to protect you. It's designed to protect the people who broke it. And unless something changes, it will happen again.